Ever feel like Wall Street has all the secrets? Well, what if I told you the legendary investor Peter Lynch built his entire philosophy on the exact opposite idea, that you, the amateur investor, actually have a hidden advantage? So let's crack open his playbook and see how you can learn to turn your everyday observations into some pretty extraordinary returns. And it all starts with this kind of radical idea. Lynch was convinced that by the time a stock is getting all the buzz from Wall Street analysts, you've probably already missed the boat on the biggest gains. The real opportunity, he said, lies in what you can see with your own two eyes. So here's the game plan for today. First, we're going to talk about your unique advantage. Then we'll dive deep into Lynch's famous six stock categories. And finally, we'll see how you can put it all together to build a powerful investment story for any company you're looking at. This right here is the absolute foundation of Lynch's entire method. Your personal day-to-day experience isn't just noise. It's your most valuable research tool. It's what he called common knowledge. I mean, just think about it for a second. You notice that new restaurant in town always has a line out the door. Or you see that one particular brand of sneakers is suddenly on everyone's feet. Maybe you work in an industry and see some small, nimble company that's totally changing the game. That's your local edge. It's your head start. Okay, so once you've spotted a company that looks interesting, Lynch's next step is absolutely crucial. You have to figure out what kind of story you're dealing with. He was adamant that you can't have a one-size-fits-all approach because, well, not all stocks are created equal. And so he broke them down into these 6 distinct categories. Seriously, understanding which bucket a company falls into is a game changer. It tells you what to expect, what to watch out for, and this is a big one, when it might finally be time to sell. All right, let's kick things off with the big, steady players in the game. You can think of these as the bedrock, the foundation of a lot of solid, long-term portfolios. First up, you've got the slow growers. These are the giants, right? The massive, mature companies that have already had their big growth spurt. Think of a huge utility company. They're not going to double in price overnight, but Lynch pointed out that they often pay out these really nice, generous dividends, mainly because they're making more cash than they know what to do with. Next, we have the stalwarts. Now think of household names like Coca-Cola or Procter & Gamble. These are huge, incredibly reliable companies that still crank out a respectable 10 to 12% growth year after year. But here's their secret weapon. Lynch loved them because they're like a shield during a recession. I mean, people are still buying Coke and toothpaste even when times get tough. So to really put it simply, you look to a slow grower mainly for that steady dividend check. But you look to a stalwart for a solid combo of moderate growth and stability when the market gets rocky. See? 2 very different jobs inside your portfolio. Okay, let's shift gears and move on to the more thrilling and, yeah, a little more dangerous categories. This is where Lynch found the stocks that could literally transform a portfolio. Now this was Lynch's absolute favorite category, the fast growers. We're talking about small, aggressive, innovative companies that are expanding at a blistering 20 to 25% a year. This is where you hunt for what he famously called 10-baggers, an investment that grows to 10 times what you paid for it. The trick, of course, is finding one that has a strong business and plenty of room to keep growing. And then you have the cyclicals. Think of industries like cars, airlines, steel, companies whose success is tied directly to the ups and downs of the economy. Lynch gave a huge warning here. This is where so many investors get crushed because they mistake a cyclical for a safe, steady stalwart. With these guys, timing is everything, period. So you're really wearing 2 totally different hats here. For a fast grower, you're a detective, looking for a great business with a fantastic story. But for a cyclical, you have to be more of an economist, trying to buy when the industry is in a slump and everyone else is running for the hills. Get that timing wrong, and wow, the losses can be brutal. All right, and finally, we get to the special situations. What's so cool about these is that their success doesn't really depend on what the overall market is doing. They're marching to the beat of their own drum. First, you've got the turnarounds. These are the comeback kids. We're talking about companies that have been beaten down, written off, and left for dead. But if you can spot one that has the grit and the cash to survive and actually fix its problems, the rebound can be absolutely spectacular, no matter what the rest of the market is doing. And this perfectly illustrates the power of your local edge. They're called asset plays. This is a company that's sitting on some kind of hidden gem, maybe some valuable real estate, a patent, a huge pile of cash that the pros on Wall Street have completely missed. And you might know about it just because you live in the town where their undervalued property is located.
Okay, so you found a promising company and you've put it into one of Lynch's 6 categories. That is a fantastic start. But it's really only half the battle. So what do you do now? What's next?
Well, this is where you go from just identifying a stock to truly understanding it. Lynch called this developing the story. It's about moving past the label and really getting to know the business inside and out. This is maybe his most famous piece of advice, and for good reason. Putting a stock in a category, that's the what. Doing the research, that's the why. You need to be able to explain to someone, in about 2 minutes, exactly why you own a particular company. If you can't do that, you probably shouldn't own it. And what's great is how practical his research was. He wasn't getting lost in complex formulas. He just focused on a few simple, powerful checks. Is the PE ratio, which is just a quick way to see how expensive a stock is, around the same number as its growth rate? Does it have a ton of debt? He always said a company with no debt can't go bankrupt. He also looked for red flags, like inventory piling up faster than sales. And this is a big one. Does the management team have their own skin in the game? And please remember, this is not a set it and forget it kind of thing. A hot, fast grower can mature and become a boring old stalwart. A stalwart can stumble and turn into a turnaround candidate. That's why Lynch insisted you have to recheck the story every few months just to make sure the reasons you bought it in the first place still make sense. And let's wrap up with this piece of timeless wisdom. Lynch saw market chaos completely differently than most people. For him, a market panic wasn't something to fear. It was a buying opportunity. It was your chance to finally buy those amazing companies you've been watching at a huge discount. Look, by using these categories and understanding the story, you're not just going a ticker symbol anymore. You're investing in a business that you actually understand. So the question isn't what the experts are hyping today. The real question is, what story are you seeing out there in your own world, just waiting to be told?